Hello, everyone. Welcome to another ShareWise webinar. I am your host, Caitlin Chung, and today I am joined by the Chief Economist of Betashares, Dave Bassanese. Thank you so much, Dave, for joining me today.
Great to be with you.
So today, Dave will take us through a presentation, giving us an economic update on the markets, and then we'll go through a live Q&A. You're more than welcome to put in your questions in the Q&A chat box down below throughout his presentation, and we will address them after. With that being said, I'll hand it off to you, Dave.
Great, thanks. Thanks for logging in today. I'm going to give you an overview, but let me just share my screen first before we begin. Share. Economic state of play, covering the Australian market and global markets and some investment implications. There we go. Obviously, just general economic information, certainly not personal advice in any capacity. The usual disclaimers apply. This is how I'm going to break it up. Talk about Australia first. Probably the most interesting development globally at the moment is what I'm dubbing the miracle on Wall Street, the idea that America seems to be avoiding the need to go into recession. Many were fearing a recession in the economy to bring down inflation. But as I'll get into, that risk seems to be mitigating at the moment, which is very good news ultimately for markets. And then what that means for financial markets and the third element. So firstly, on the Australian economy, just a chart of inflation here. As you can see, by the historic standards of the last couple of decades, COVID, the afterwash of COVID was that we were left with a surge in inflation as goods and services demand sort of ran ahead of the ability of supply to respond. So inflation got up to pretty high levels. But as you can see, it has been coming down. So it basically peaked late last year and the trend has been down. The big question is, will it get down quick enough so that it doesn't get embedded into inflation expectations and wage and price setting behaviour? Because if it does, there's a risk we return to the bad old days of the 70s and 80s. At least that's what central banks fear. And that's what we've been, why the Reserve Bank has been, raising rates and trying to slow the economy a bit to bring down inflation. But so far, so good is that inflation has peaked. It's coming down, though it does still remain uncomfortably high. At the same time, we've had the RBA raising interest rates. Consumer spending has been slowing, but at this stage, at least, the unemployment rate is still pretty low. It's edged up a little. It did tick down it reached a low of 3.4% at one point, but broadly about 3.5% over the past year. And as you can see, if you look at that slide, if anything, there's been a slight upward trend, and it is likely to edge a little bit higher over the next year, as I'll get into. But that is the current state of play. Despite the RBA raising rates, the economy has so far held up pretty well, and the unemployment rate remains pretty low. The RBA, in response to the still high rate of inflation, the resilience of the economy has been raising rates. You can see there the current RBA cash rate is at 4.1%. Up from a 0.1% low back in during COVID in 2020, and just since around early last year, we've had one of the most aggressive tightening cycles that we have seen in the modern era in Australia, going from 0.1 to 4.1 in the space of a year. The result of all that is that consumer spending has been slowing. So the first slide there just shows you the dotted line there. It's overall real consumer spending, and you can see that you can see the impact of the lockdowns there. But what's been interesting is that as we emerge from lockdowns, as we sort of let people out of their homes and back into the shopping centres and planes and trains and automobiles, we've had pretty strong recovery in consumer spending each time. In 2020, 21, but more recently, it's from around about 22, middle of last year, you can see that consumer spending has slowed to a crawl effectively on the back of weak income growth. So higher interest rates, higher inflation have been eating into real income growth, and that has been slowing consumer spending, which is about 60% of the economy. So that that's pretty critical. If 60% of the economy is slowing to a crawl, the overall economy is likely to be fairly soft as we've been seeing. And one, I think, interesting aspect of that, just on the first slide here, this is the increase in central bank interest rates around the world. You can see Australia, other countries have increased rates more aggressively than Australia. If you look at the case of the United States, for example, but the increase in mortgage rates, the average mortgage rate for everybody that has a mortgage has been a lot less in the US and the UK compared to Australia. You can see Australia there is in the dark blue. So here's Australia up here. So we've had an almost 300% increase in mortgage rates, less than 100 basis points, a 1% increase in the US. And that's because many households in the US have fixed rate mortgages, fixed for 30 years, many of which were locked in during the COVID years of very low interest rates. And so although we have raised rates less than the US, the impact on consumers through those with a mortgage has been pretty significant. So that's why we haven't had to raise interest rates as much as the case in as the case in other countries. You can see here the pass through of the increase in lending rates to mortgage rates has been relatively higher. And this is the increase in the rates flowing through to deposits. Not as interesting as this one, but households in Australia that do rely on deposit income have benefited relatively more as well, because more of that variable rate mortgage more of the short-term increase in interest rates flows through to deposits in Australia than is the case in other countries. We've seen so far only a modest increase in housing loan default rates. So again, despite the increase in interest rates, the mortgage rates, the slowdown in consumer spending, most people are still maintaining their ability to keep meeting their mortgage repayments. Many people have been ahead of their mortgage repayments. They've been paying extra repayments in recent years, and so they've got a bit of a buffer. So in many cases, people's mortgage, although interest rates have gone up, the actual nominal amount of interest payments they make each year, or mortgage servicing, if you like, each month, doesn't change, but the percent of that which is going toward interest versus increases, and the percent that is going toward paying down capital or paying down your loan decreases. And so that's been one way in which people have dealt with the increase in interest rates, is just to end up paying the same nominal amount, but less of that being used to reduce the loan outstanding. But either way, despite all the fear of the so-called mortgage cliff, I mean, the other aspect in Australia is many people took out fixed rate mortgages for 3 to 5 years during 2020-21, when mortgage rates were very low, fixed rates were very low. Many of those households are now facing higher repayments as they switch into variable rates or higher fixed rates. But so far, at least, the increase in default rates has been pretty modest. So that's the situation with households, and that consumer spending has slowed. People have been tightening their belts in order to meet their higher mortgage repayments. At the same time, housing investment has been slowing. So this is the other major element of the slowing in the economy. Not only consumer spending, but housing construction. This orange line is the value of housing construction. And this dotted line is building approvals, and it's with a lead. And so you can see where building approvals go over the coming year is a good indication. Where they've gone is a good indication of where housing construction is going to go over the coming year. So that's likely to remain soft as well. We're seeing hiring intentions easing. So businesses' demand for labour is starting to soften. Both the NAB Business Survey indicator of employment intentions and the ANZ Job Ads series. Look, they're still at okay levels. They're still far from recessionary levels, but they're just sort of coming off their peaks. which adds to the idea that the unemployment rate is going to drift up somewhat over the next year. In terms of globally, what's been interesting, China has slowed down. It's dealing with a major property imbalance, but overall demand for steel from China has still been okay, and such that iron ore prices, you can see here, haven't really fallen in a significant way over the past year, despite the slowdown in the Chinese economy. And essentially what's happening is the demand for property, developers are still having to build properties. They're getting financing from the banks. They're finding it hard to sell those properties. There is a bit of a glut, but at the moment they are still building. But also China's having a bit of a manufacturing boom, particularly given construction of electric vehicles. And of course, the government is continuing with major infrastructure programs as well. So the economy is still ticking over despite all the negative headlines and focus on the property sector. And we're seeing that the fact that iron ore prices are still holding up, which means that mining revenue is still holding up, which means that taxation, a big chunk of taxation comes from the mining sector, the royalties from iron ore, and just from overall income. That's been supporting the budget, the budget getting back into or back towards surplus, the federal budget, quite nicely over the last couple of years. So this is the outlook for the economy, is that a modest further slowing in growth. Here, this is some forecasts from the RBA Statement of Monetary Policy that comes out every quarter. There will be an update of that next week. Won't change too significantly, but generally we're going through a slowdown. That slowdown should continue for a while, at least until early next year, and then a gradual recovery as the downward pressure on consumer spending eases. In particular, inflation coming down, boosting real incomes, and the interest rate, RBA, the rate hike cycle, ending. Associated with that, you're seeing the unemployment rate. The forecast is for it to get up to around about 4.5%. So basically a 1% increase over the next couple of years. That's still a fairly gradual increase, and it's still a fairly low unemployment rate. So you wouldn't call that a recession. You call it a period of below trend growth. But that would be a fairly benign outlook if that's all we ended up getting over the next year or so. Inflation, again, this is the whole reason the RBA has been raising rates and trying to slow the economy. It wants consumer spending to be soft so that businesses are sort of, required to cut prices or stop increasing prices as significantly as they've been doing in a whole range of areas, from groceries to healthcare to airline flights, hotel rates. I mean, the strength of the rebound in the economy post-COVID has allowed businesses to, increase prices to recover margins. And the downward pressure hasn't been as great as we've seen in other countries. So we do need to see consumer spending slow. But this is the RBA's forecast of that. And again, I think what's important here is that the RBA is being somewhat patient in waiting for inflation to go back to the target. The RBA's target is 2 to 3%. Trim mean is a measure of underlying inflation in Australia. And this is essentially the one they sort of target on an ongoing basis. And the RBA's forecast is that on the view of a slowing in the economy, inflation will continue to edge down, but it won't get back to the 2 to 3% band until early 25. So even through next year, it's still going to be above 3. But provided the trend is in the right direction, the RBA is comfortable with that. If they think that inflation is going to take longer, if they think it's going to stay up here for longer, that's when they may raise rates more to ensure you get a slowdown in the economy. So they are being patient, but they're not they're not going to wait forever, because the longer they wait, the fear is that it gets embedded into inflation expectations, as I said. And then it becomes harder to get rid of, later, and maybe you need a deeper downturn and a potentially recession to deal with it. So that's the framework and the thinking of the RBA at the moment. And you can see that at the moment the markets are pricing in. Actually, having said all that, there is a pretty good chance the RBA does raise rates next week. I now actually think they will raise rates one more time next week on the back of a bit higher than expected inflation result that we did get last week. And so the RBA at the moment has a forecast of underlying inflation hitting 4% by year end. The numbers last week suggest that could be a stretch, and maybe it's going to be 4.25%, not 4%. And they did say that they have a low tolerance for inflation falling less quickly than they hope. So that likely upgrade to their inflation forecast next week, when their statement of monetary policy comes out, may be the reason that they raise rates on the Tuesday. So the statement comes out on the Friday, and then and so on the Tuesday when they have their meeting, it wouldn't surprise me. Don't be surprised if there's a rate rise on the back of somewhat higher than but it's not a done deal, because there is a debate going on, I think, at the bank is that upgrade to the inflation outlook material enough to justify an increase in rates, given particularly, the slowing we are seeing in spending, given the new tensions globally, the upshot of the Middle East tensions. But ultimately, I mean, I think that as horrible as the situation in the Middle East, it doesn't look as if it's going to be particularly jarring to the broader global economy. We're already seeing oil prices, after having initially picked up, have come back down again. So the global market thinks that the Israel, Gaza, Hamas sort of, I guess, battle is going to be contained, and it's not going to drag in many other countries. It's not going to lead to any disruption to the oil market. So on that basis, I still think the case is that the RBA may well raise rates next week. House prices are another reason why the RBA may be inclined to raise rates. We've seen a pretty speedy rebound in house prices over the past year. So this is an index of national house prices as produced by CoreLogic. And so as you can see there, we had a 10% decline, almost a 10% decline in house prices since early 22 to early 23. But since around March, April, you can see the market has almost fully recovered those losses. And in fact, only yesterday we saw that the October house price index rose another 1%. And so, we're almost back to the peak levels. The RBA doesn't want to see house prices rebound too quickly because it doesn't want to see it crash, but it doesn't want to see a very strong rebound either, because that will add to consumer wealth expectations. It will make it harder to get consumer spending to remain soft for a while. So that, again, another reason why the RBA may be inclined to raise rates at least one more time next week. And you're seeing a broad-based rebound in house prices around the country, actually. Now, I'm going to just quickly in the interest of time, I'm going to just cut through that. That's really in terms of the Australian economy, the situation at the moment. I'll just sort of touch on very quickly some issues in the markets. This is a chart of the US unemployment rate in grey and what's called the job vacancy rate. It's a measure of total jobs outstanding as surveyed by businesses. And what we saw early this year was a very high level of job vacancies with a very low level of unemployment. And the US market had a major imbalance, excess demand for labour, and it had wage inflation going up. It was adding to inflationary pressures. And this is why the US central bank was raising rates. And many economists, myself included, was fearing the US would need a recession to get inflation back down again, because historically, every time you've tried to bring down demand for labour of job vacancies, if you see there historically, you've had an increase in the unemployment rate almost at the same time. And once that unemployment rate starts moving higher, the economy typically tips into recession. But what we've seen over the past year, and particularly become more evident over the past 6 to 9 months, is that job vacancies have been easing, and yet the unemployment rate has not gone up. And that's because job vacancies have been easing because of a rebound in labour supply. Workforce participation has recovered from COVID. Immigration into the US has recovered. And so those unfilled jobs have been filled by people, coming back into the labour market. So that's been a very positive development. It's meant that excess demand for labour has been reduced without as yet needing to to slow the rate of demand for workers and push up the unemployment rate. So it's this very unusual development of vacancies falling without an increase in unemployment is why many now think we can get away with the US slowing down a bit, but certainly not going into a sharp recession, and why the central bank over there, the Federal Reserve, is close to done, if not done, in terms of raising interest rates as well. And just another indicator on that, this is a chart of small business survey of pricing pressure in the US. And you can see that has come back. So this is the net balance of small businesses that expect to be raising interest rate prices over the next few months. You can see that the percent of businesses, and this is a deviation from its long run average, it's almost back to average from very high levels. And so that historically should be associated with a nice decline in inflation back toward the Federal Reserve's target of 2%. So bottom line, in terms of the US economy, is that the fear of recession that's been lingering since around the middle of last year, since the Fed started raising rates, has been easing because inflation has been coming down and the labour market has been healing itself without a major increase in the unemployment at the moment. And that's because of that positive labour supply. So it's a very positive development. What does this mean for markets? I think bond yields are close to a peak. In fact, today they just hit 5%. So we've had a major, you can see a very major rebound in bond yields over the past year or so. It looked as if it was stabilising for a few months in the middle of this year, but more recently we've had a leg higher. And that's because markets have given up on the fear of a US recession. Markets were pricing in rate cuts as early as the first half of next year. As they've given up on those rate cuts, has pushed up bond yields. But ultimately, bond yields, I think, are going up for good reasons, going up for reasons that we no longer fear the US having to go into recession, because the inflation indicators, as I said, are still quite positive. I think the Aussie dollar should start to recover. It's in the low 60-cent range, but as growth stabilises, as the US gets around to eventually starting to cut interest rates, as fear of a slowdown in the global economy ease, I think the US Aussie dollar should start to strengthen over the course of next year. Our market also, you can see it's been in a very choppy sideways range, the equity market. That's because we've had some earnings. We had very strong rebound in earnings on the back of higher commodity prices and energy prices. As they've come back down, we've gone through a period of quite flat earnings, but earnings are gradually expected to recover over the next couple of years. That with an increase, with an eventual decline in interest rates, should see our market, eventually break to the higher end, break out of this range, probably to the higher end. I won't tackle too much of the other elements. So just maybe out of interest, this is a broad trend of markets. When you think about equity market trends, one of the key, demarcation points in markets is so-called growth versus value. High-priced, typically technology stocks versus more lowly priced or companies trading on lower PE ratios, things like financials and energy. And there's a great, tension between which is going to outperform the growth technology stocks or the value resources and financial stocks. And you can see here that we've gone through major periods since the GFC. It's been a story of technology and growth outperforming value. The PE premium of growth has started to get relatively high, not as bad as we got during the dot-com bubble of the 2000s, but certainly getting to a highish level. And that may suggest that we could start to see a bit of a rotation back into value, back into things like energy and financials, if only on a relative value basis over the coming year, which ultimately, again, could favour the Australian market because we do tend to be overweight financials and energy relative to the technology sector globally. I'll leave it there in the interest of time and open it up for questions.
Thank you so much, Dave. That was such a good update on the market overview and the economy. For those that have just joined throughout the presentation, as mentioned before, you can pop in your questions in the Q&A chat down below and we'll go through them. But to get started, you were talking about how you think the interest rates will rise next Tuesday. Now, I want to ask, what is the major breakpoint that we have to see for economies to swing down? Do you think is it simply reliant on the increasing inflation that you were discussing?
You mean what do we need to see the economy tip into recession or something? Or is that
for the interest rates to start going down again?
Oh, okay. What do we need to see? Okay, yeah, good question. Look, ultimately, further confirmation that inflation is trending back to target. It doesn't need to get back to target, but it just it needs to be continuing to go on that course. And so, as I was saying in the presentation, at the moment, the RBA is saying as long as it's reasonably confident inflation is going to get back to the 2 to 3% band by let's say early 25. They don't need to push the economy any harder into a slowdown. And at some stage they'll be able to cut interest rates. So look, they might cut interest rates if the economy suddenly starts to slow more quickly than we're seeing. If suddenly employers start slashing jobs, consumer spending really starts to capitulate. Housing default rates start to go up. If it looks as if we're going to have a harder landing than the RBA currently expect, they will cut interest rates, subject to what's happening with inflation. But that would be one catalyst. But at the moment, the economy is showing, pretty good resilience to the rate rises. And so the other reason they'll cut rates is once, we get further confirmation of that decline in inflation, which on my estimate suggests they might cut rates by around about middle of next year, maybe even later next year. At the moment, inflation is still too high for them to be able to justify that.
Okay. And I know a topic on everyone's mind is the Israel conflict right now. And I know you said that it's not had a jarring impact on the global economy. Why is that? Because do wars not typically have an impact on the global economy quite massively?
I guess the first point to note, Gaza and even Israel to an extent are a relatively small part of the global economy. I mean, it's one, so a war between Hamas, let's say, and Israel is a lot different in terms of orders of magnitude than US-China.
Yeah, of course.
So that would be, or Russia, Germany, or something like that. So, firstly, the first question I'll ask you is how big are the economies? Even Russia, Ukraine, ultimately, as terrible as the situation is for Ukraine is a relatively small part of the global economy. And the big fear last year was that, Poland could get dragged into the war. Germany might be forced to retaliate. That was the worst case sort of scenario there. The other aspect with Russia, Ukraine was the sanctions imposed on Russian oil could cause oil prices to go up in a major way, create inflation. Central banks have to aggressively respond, and that could cause a global recession. What we saw last year was that, again, there were sanctions imposed on Russia, but Russia got around those sanctions. India still took Russian oil, China took oil, even the Middle East took Russian oil, which is bad in a sense that you want to discipline Russia, but it was good in the sense that if they didn't take Russian oil, the shortages globally would have been worse and oil prices would have been a lot higher. So ultimately, Russia's ability to evade those sanctions meant that the Russia-Ukraine war didn't blow up as many feared. So in the case of Israel and Hamas or Palestine or Gaza, whatever you want to name it, the opposition, firstly, none of them are major oil producers. The big risk for markets is if Iran, which is a major oil producer, it exports about 2 million barrels a day and produces 3 million. If they were dragged into the war and the US felt a need to, and Europe felt a need to impose sanctions on Iran, and that led to oil shortages, that's what markets fear at the moment. That's one fear. The other fear, of course, is if the major Middle Eastern countries get dragged into war. If Egypt and Saudi Arabia, heaven forbid, declared war on Israel, I mean, that would be pretty diabolical in terms of an outlook. But at the moment, it doesn't look as if those countries are going to get dragged into that because the US is obviously very staunchly behind Israel, and so that's helping limit that risk. And at the moment, the world needs Iran oil too much that they will avoid, if they possibly can, having to impose sanctions on Iran, because we need that oil. So in the same way Russia got around the sanctions, Iran is currently getting around the sanctions that already exist on Iran, and I don't think the world will find enough of a justification to have to impose sanctions on Iran. So a long-winded answer, but that's sort of the way people are thinking about the war at the moment, or the tensions in the Middle East.
Okay. And a viewer has asked, you mentioned that there has been a major rebound of bonds. Is now a good time to invest in bonds? And if so, which Betashares fund is best?
Yeah, I think it is now a good time to invest in bonds. I mean, I'm being very surprised by the sell-off, because the sell-off over the recent weeks has happened at a time when, you know, central banks are still talking about we're close to done, we're virtually done in raising rates. Don't expect another further major rate increases, because inflation's coming down, growth is slowing. All that's happened is that the hopes of rate cuts early next year have been particularly in the US, has been priced out of the market. Now, there's other issues going on. People said it was about inflation and oil, but oil prices have come back down after that initial Hamas attack on Israel. Oil prices have come back down. So I think, ultimately, I think bonds are attractive here. And if the central banks do start to move to cut interest rates next year, at least by the second half of the year, I think 10-year bond yields and Australian bond yields, which are currently at 5%, could get all the way back down to 4%, even 3.5%. So you're getting a good income, but you're also potentially getting some nice capital gains from bonds. So what to invest in? A lot of different options in our suite of funds. The most obvious one is something called OZBD. It's the Australian Composite Bond ETF. Gives you a mix of government and corporate bonds. If you want a pure corporate bonds, is CRED, C-R-E-D, gives you a higher yield than that. If you really think that globally bond yields are coming down and you really want to get the capital gain of that, you want a longer duration type bond exposure. And we have an ETF called GGOV, G-G-O-V, which invests in long duration US Treasuries, something like a 20 duration, something. So basically means if bond yields fall by 1%, the capital gain on that could be up to 15% or so. So it's a very high exposure to the decline in bond yields. And the last point to think about bonds at the moment is the risk return on bonds is interesting, because given the yields are at 5%, even if bond yields go up a bit more from here, the capital loss you make on them is going to be more, at least offset to a significant degree by the income you're getting from them. Meanwhile, if bonds do fall, bond yields fall, you get that income plus you get the capital gain. So there's an asymmetric payoff, to use a too technical term at the moment, in terms of bonds.
Okay. And another question we have is, what is your forecast for gold price?
The gold price is, I think the gold price should do well next year. It's actually, so the two key drivers of gold prices are global bond yields and the US dollar. Now, the rise in bond yield, just in the last couple of weeks, it's been interesting. Bond yields have sold off, but gold has held up okay. And I think that's because the flight to safety at the moment hasn't been into bonds, it's been into gold. I mean, equities have been on the back foot, bonds have been on the back foot. So people have been moving to gold. I think, the war fears, ultimately war fears and potentially the inflationary consequences of that has supported gold in the short run. But longer run, if bond yields fall next year and if the US starts to cut interest rates more aggressively than other countries, because they did raise rates more aggressively, and the risk sentiment improves such that the risk premium on the US dollar eases, and the US dollar, which is very strong at the moment, starts to ease, falling bond yields, falling US dollar would be supportive of gold, even in an environment where inflation's coming down. So it's a kind of a different dynamic. People usually think gold goes up when inflation goes up. Not often the case, because if bond yields go up by a major way when inflation goes up, that doesn't help. It doesn't help gold and also if the US dollar goes up at the same time. So in summary, I think the more important factors for gold next year will be easing bond yields, easing US dollar, which should be supportive of gold, even as global inflation does start to come down also.
Okay. And talking more to the domestic landscape, do you think Australia will see any future economic growth other than from immigration? We're very, very, as you know, heavily reliant on that.
Yes. Yeah, so at the moment, so the two ways to get economic growth is obviously new workers, immigration, and output per head, or what we call productivity. So the sum of those two gives you total output. At the moment, we've had a very strong rebound in new workers, and that's underpinning economic growth. But productivity, output per head, has been very weak. Now, there's a lot of the productivity measures are very rubbery, so I don't lose a lot of sleep about stories about weak productivity growth as revealed in the national accounts. At times it grows in fits and starts, and it's a very rubbery concept, but I mean, ultimately, it does grow over time, and I think productivity, having gone through a flat patch at the moment, will start to recover, and that will, start to contribute to economic growth. I mean, we just see, all the technology improvement around us, even now the move toward artificial intelligence and robotics. There's no reason to think, output per head and productivity growth can't continue to grow over time.
Okay. And another question submitted is that you mentioned the Australian dollar rebounding next year. What is your forecast for the Aussie dollar versus the US dollar? And similarly, another question submitted is, with the Australian dollar rebounding, how high does he think it will get?
Well, forecasting currencies is obviously is one of the hardest games in financial markets. It's but my forecast is 68 cents at the end of next year, so up around 4 to 5 cents, from where it is at the moment, around 63-ish cents. So that's up. I mean, it could be higher than that, but look, long run, I think it's pretty weak at the moment. And as I said, those reasons that I outlined, I think it should start to strengthen. Will it go a lot higher? I don't know. I don't think we're going to revisit a dollar. Back a few years ago when China was booming and commodity prices were a lot higher than they are today, the Aussie got up to $1. I don't think it's going to get up to those levels, but it could test 70 cents, over the next year or so. Maybe get back up to 75 cents. But at the moment, I don't see the fundamentals going a lot higher than that.
Okay. And do you think that housing prices are going to keep rising?
Yeah, I think they are. I mean, it's so again, at the moment, we have a supply constraint in Sydney and Melbourne, very strong immigration rebound. We've got many households that, unemployment is still at 50-year lows. It's going to drift up, but still remain pretty low. Yeah, I mean, I think house prices will probably, maybe the rate of increase, we've had almost a 10% rebound within a year, fully recovering all the losses that we saw through the course of last year. So we may start to see, a slowing of that, but the case for a house price, major collapse is certainly, out the window. Some people were talking about 20-30% decline. I don't see recession in Australia. I don't see the RBA needing to raise rates a lot more than what they've already done. I don't see immigration, being cut back significantly anytime soon. I don't see the development constraints, particularly in cities like Sydney and Melbourne, easing anytime soon, despite what governments say. So all of that points in the direction of, continued, upward pressure on house prices.
And we have a question. What's your view on the relationship between the migration and housing prices?
Well, look, house prices around the country have been going up, even in states that aren't getting strong immigration. Now, I think in the case of Adelaide, they haven't been getting, directly strong international immigration, but they have been getting strong internal migration. So people have been leaving Melbourne and Sydney and moving to cheaper cities such as Adelaide, which has boosted their prices. But it's certainly a positive. I think no one would deny, letting in, 200,000, 300,000, 400,000 people each year who need to find a place to live. It doesn't add to upward pressure on house prices. It's the one of the consequences of accepting accepting a high rate of immigration. And the problem is we tend to be very highly urbanized. Most new immigrants tend to want to settle in Sydney and in the major capital cities. They don't immediately go out to the rural areas, and that's because that's where the jobs are in the major capital cities. So it just adds to the pressure, unfortunately.
Okay, and I think we'll have one more question. What do you think the long run outlook for China is?
I think China is definitely starting to go post-growth or ex-growth. I mean, it is now growing at like a 3% rate, closer to the standards that we see in the Western world, the US, Australia. It's still a very large economy. Even 3% growth in an economy as large as China is still a nice contributor to global growth. But it does face a lot of structural challenges going forward. It's got population aging of the same order that we're already seeing in Japan. In many cities, it's already caught up to first, developed world standards. In the case of Beijing and Shanghai. So the growth, ongoing growth potential is certainly nowhere near what it was. I think it does certainly face challenges going forward in maintaining reasonable growth, because at the moment a lot of the growth has been top-down driven as well. It's been driven by housing construction projects, infrastructure projects, not a lot of bottom-up consumer spending. The economy's become more regulated, not less regulated. So I think the challenge, I think it's certainly past its best years in terms of growth. But I don't foresee them. The government will keep doing what it needs to do to keep the economy ticking over, at least to avoid, social unrest in the streets and a threat to its own political power. But I don't think it can certainly return China to the high growth years of the past.
Okay, well, thank you for that, Dave. With that being said, we'll end it here. Thanks so much for joining me and that really great presentation. To everyone watching, this will be posted on YouTube if you'd like to revisit it. But thanks so much, Dave.
Okay, thank you. Bye for now.
Bye.